Tuesday the 28th, good morning. What do you need to know? Chip stocks are having another very bad day. That's certainly top of the agenda right now. Trump also sees a, quote, good chance of a deal with Iran. Oil is definitely down on the back of that. And Barclays Q2 numbers are dropping right now. Venkat will be along shortly to give us the details. Anna.
Let's put into numbers that very bad day for chip stocks, and you can see it very nicely expressed by what's happening on the Kospi today. This is just one day's move on the Kospi. We're down by 10.7% on the Kospi today. We're worried about a host of things. We're worried about capex in AI. We're worried about circular financing, and we're worried about what the Chinese can do in the AI space. What does all that mean for Europe? Well, Europe actually saw some of this tech selling yesterday. ASML down substantially on some of that news out of China and Chinese competition. So that pairs the extent to which we'll be pushed to the downside by the tech theme, but maybe there's more in it. For the moment, European futures down 0.1%. Lots of earnings to factor in. They don't all look good, but we're down by 0.1% on Euro Stoxx 50 futures. At least the oil price is not rising. 87 is the handle that we have on oil this morning. The countdown to the opening trade starts right now.
Morning, Tuesday morning. Good morning. I'm just reading through the Barclays numbers, which look quite interesting. We'll get to Venkat in just a moment. Let's talk about the tech story. Tech is being hammered. Whichever way you look at it, tech is under real pressure. You can start with the chips. They don't look particularly clever. You've got the ASML story on the idea that actually the Chinese are making some significant breakthroughs when it comes to lithography, and that's going to open up a whole new realm in terms of China's ability to compete. But take a look at what's happening with the CDSs of hyperscalers. Take a look at what is happening with the circularity story when it comes to financing out of Nvidia into the rest of the group. All of this is on the table right now. Whichever way you look, you are under pressure in this space right now. But chips are front and centre.
Yeah, absolutely. Chips are front and centre, and we thought useful to linger on this as we head into a busy earnings day in Europe, where our attention will be understandably diverted in other directions for a moment. But we are seeing substantial losses in the Asia session, as we were saying earlier, 10.5% down on the Kospi. And some of the individual names that are considerably weaker, it's some of the chip makers, so Samsung, SK Hynix, of course, but also over in Japan, Kioxia, so it's not only about South Korea. Nikon and Tokyo Electron also down, and that's linked to the ASML story, the fact that the Chinese have now a competitive threat to ASML in the chip equipment making space, and so those companies are down in the Tokyo session. So interesting to see to what extent this comes through into Europe today. We are seeing slightly weaker futures for Europe. I'm also intrigued by the CDS story around the likes of Nvidia and SoftBank, and Anthony Stevens pointing our attention in this direction. There were a lot of things that the market didn't like, it seems, about the Nvidia OpenAI financing, just once again focusing in on the circular nature of some of this financing. And the FT has another story about Nvidia signing a lease at a data center in Texas that has similar hallmarks. And so it seems as if this is an area of concern for the markets.
Yeah, and this is all ahead of the hyperscalers. So that we haven't even seen the hyperscaler numbers this week. We thought that was going to be the major event, but it looks like this already is signalling a great deal of concern around what is happening here. If the hyperscalers come through and signal that they're going to continue to spend at the rate that they are right now, we've got 4 of the 7 reporting this week. How is the market going to take that, considering the backdrop of the concerns that we have right now? Where is the money? Show me the money. How are you going to make money on this huge investment that you're delivering right now is going to be and will remain the key question. Yeah,
absolutely. Still not sure what it is that we're looking for in capex. Do we want to be reassured by higher numbers, or do we want to be reassured about discipline and slightly lower numbers? But all of that still to play for. Lots to talk about when it comes to the technology space over the next couple of days. And just as a reminder, tomorrow we've got Meta, Microsoft, Qualcomm and SK Hynix. And then on Thursday we have Apple, Amazon and Samsung.
So what I thought was interesting about yesterday's session in Europe, ASML, biggest points drag by a mile, no problem at all, 2 points off the Stock 600. But if you look at the other end of the story, SAP had a great day. Capgemini had a great day. So the market rotated out of some of the hardware trade back into some of the software trade, which was quite interesting. And if you look at the equal weight in the US on the S&P, it had a very good day, hit a kind of fresh record high. So the market is kind of rotating out. The money's not coming out of the market. Some of it's finding its way into other parts of the market. How sustainable is that particular trade
We will talk later about what that broadening trade means. Is it all good? We'll get into that conversation. Let's dive into some of these earnings stories that we're getting this morning, and there are plenty of them this morning. Let's start with the listed hedge fund space and Man Group. So we get numbers out of Man Group this morning. First half net inflows really really comfortably beating the estimates. So we've got a number here of 7.1 billion in net inflows for the first half of the year. That is against an estimate that's sort of just above 2 billion. So that's certainly well above estimates. The assets under management then looking well above estimates. The pre-tax profit looking above estimates. So let's get into a conversation. We're joined now by Antoine Forterre, who's the Chief Financial Officer over at Man Group. Really nice to see you, Antoine. Nice to have you with us. So that net inflows number really stands out. Tell us what you think has been driving that money coming towards Man Group in the first half of the year.
Morning, Anna. Morning, Guy. Thank you very much for having me today. We're very pleased with the results this morning. We delivered very, very strong earnings, as you can see. Very solid investment performance across the range of products. Record net flows, as you've highlighted, leading to record AUM. And our management fee EPS has grown to the highest level in 15 years, 46% growth in the year. But if you go beyond the numbers, what is particularly pleasing is the broad-based nature of the growth you're seeing and the investment performance we're generating. Our main multi-strat is up around 7.9%, and that's the best representation of the alpha we've been able to generate for clients. And then we're seeing growth in most of the categories in our space. And so it tells us that our strategy is working, we're delivering, and that the clients, and where we started, the clients are listening, and they're interested in the content that we can deliver for them. So very strong set of numbers, which gives us great confidence for positioning and our future.
OK, and so I was going to ask you, yes, which of the strategies were doing well, AHL, numeric, GLG, but you said it's sort of broad-based. What does the volatility in the markets mean for you, Antoine? What does it mean for a business like Man Group? Because whether that is driven by the oil price and everything that's happening in the Middle East, or whether that is driven by hyperscalers or memory chips, there is a lot of volatility to either fear or to use as an opportunity.
Oh. So the demand has been broad-based across a range of products, liquid alternative, private alternative, as well as long only. And it tells us that clients are looking for solutions, product strategies that give them good quality returns in times of uncertainty, in times of volatility. We talked about the AI, the volatility you see in markets. The alpha environment has been relatively rich, either on the macro level. Some of our strategies on the macro side are up 7-8%, but also on the micro level, we're seeing our long-only equity and credit fund managers performing particularly strongly. And so in time of uncertainty, volatility, people should stick to the basics, stick to quality investment returns, quality strategies, customized, which is what we're here to deliver.
How hard is it to hang on to talent right now? What's the talent? Every day I see people moving. The talent war seems extraordinary.
Talent is one of our key strengths. You hear us talking about talent and technology. These are the two strengths of our business. We pay a lot of attention to our talent. Attrition this year is near record lows. And we invest in talent, and tools such as AI are great way to attract and retain talent. Our 40-year history in quant and technology enables us to deliver those tools pretty smoothly to organization in ways that really demarks us from competition. And that turns us into an attractive position for talent.
Is it hard to figure out what the ROI on the AI investment is? Like, how do you got the talent? The metrics kind of work there. I can understand how you judge that. How do you judge the kind of what you're doing in AI?
We're so excited about AI. As I said, we've been at it for 40 years in tech and quant, and it's really a transformation of our business. Yeah. I'll give you an example. You're a typical portfolio manager. Your role is to process disparate information, build models, interact with companies. We now have portfolio managers who have created agents who can do that for them, tremendously accelerating their throughput. They can interact with double the number of companies that they usually interact, and they can have double the number of meetings that they have. And if you think that alpha is ultimately the number of bets you can make times the probability of success of those bets, that should lead to better outcome. So we're tremendously excited. We don't succumb to what people have started calling cognitive surrender. This is a way for us to turbocharge cognitive capabilities in our business.
How do you keep the spending on AI in check in a business where it must be tempting? There are opportunities everywhere to perhaps explore some of that alpha, but it all costs money and tokens.
It costs money and tokens, but it's a resource allocation decision. And we're fortunate to have the scale, the size. Talked about the growth you're seeing, the numbers that you're seeing. That enables us to invest and really deliver the best to our teams.
Are you worried about private credit? I know this is an area, there was much excitement years ago. You've got some exposure in that space, a part of your business that focuses on private credit. Are you concerned about private credit and what might happen there?
So private credit AUM has increased to $7.6 billion across the half. And we're seeing both very solid underwriting from our teams on the direct lending side and opportunistic credit. The realized default rate is sort of 1% level on the direct lending, which is way below the kind of 4% you're seeing on the BDC space. And the opportunistic credit team has returned north of 30% annualized in the first half. So the numbers are very strong, leading to growth. We still see this as a growth opportunity for us. Clients are interested, both institute and wealth clients, and we're well positioned to capture. But we are cautious. Our positioning is one where we're here to return quality returns for investors, and it starts with the quality of underwriting.
Clients happy to put money into that space? They want their money back? Kind of what? Just give us a sense of.
Our clients are happy to put money in that space. We have no exposure to some of the structures that have sort of illiquidity mismatch that have been reported in the US. We have no exposure to those structures. In our case, clients are interested, and you see that in the rate of deployment that I described, and the fact that in the first half we had the first close of our new opportunistic credit fund at the beginning of June, and the first close alone was bigger than the full previous vintage. So it tells you that clients are interested in broad private credit still.
If you have an extra pound, euro, dollar to invest right now, is it best invested in new capabilities, AI technology? Is it best invested in your own stock, buybacks? Is it best invested in expanding the business, organic growth, non-organic growth, M&A? Where's the opportunity to grow the business right now?
The opportunity to grow the business is across most of what we do in our strategy. If you look at where we're investing, quant equity, credit and solutions, probably where I would put this extra $1 or £1. On the quant equity side, we're seeing record AUM. There's plenty of room for us to grow. On the credit side, we've now reached $60 billion of credit AUM, starting from less than 5, probably 7 years ago. And then on the solution side, huge demand for product. So the allocations we're making are across the 3 bets, and then the platform that supports it, which is predominantly about AI.
Antoine, thank you very much. Thanks for kicking off the show with us this morning. Good to see you. Antoine Forterre, the Man Group CFO. Coming up on the programme, demand in the key Chinese market remains challenging for Philips. We'll be speaking to the CEO of the Dutch medical equipment maker. That conversation later in the programme. Plus, a new fund is being launched to protect against what Altana Wealth sees as an inevitable downturn in private credit. We'll get that view later in the programme. The company's founder and CIO, Lee Robinson, will be with us on the show. Up next, don't miss our interview with the Barclays CEO CS Venkatakrishnan will be with us shortly. The British Bank reporting earnings. If you have any questions, please get involved in these conversations. IB plus BBTV Go is the function on the Bloomberg terminal that will put you in touch with this team. This is Bloomberg. Welcome back, everybody. 16 minutes past 7 here in London. The futures picture for Europe then looks flat, really, to negative, but that does not do justice to the news flow that we're seeing through the Asia session, the extent of the selling we see through the Asia session on the tech theme. The cost be down by 10.7%. Some of that is to do with nervousness around Chinese competition, and some of that was in our markets yesterday, Guy, because we had considerable pressure on the likes of ASML and the rest, or some, rightly you mentioned earlier, of the tech space, certainly around hardware. But that's the overall picture in these markets this morning.
Let's talk about the Barclays numbers. Hit the screen a little bit earlier on. They make fascinating reading. Let's talk about what's been delivered so far. So the overall numbers in terms of the investment bank are a beat. This is for the investment bank. Certainly the revenue on that side of things. The bank has upgraded its 2026 group income target to 31.5 billion. Equities have done very, very well. Fixed income, we'll talk about that in just a moment. CS Venkatakrishnan is the CEO, of course, of Barclays. He joins us now. Venkat, good morning. Quite the set of numbers this morning. Equities really stand out as being a very strong performance. Do you think that business, that side of the business, could have done even better if it had even more access to capital? Is it being throttled? Is the performance of that business being held back, do you think, right now?
No, not at all. Well, first of all, thank you for having me. I'm absolutely pleased with the set of numbers we've published today. You know, our top line income of £8.1 billion is up over £1 billion on the same number last year. Profits of £3.3 billion are up 30% over the previous year. And the investment bank, as you say, has done extremely well, including my colleagues on the equity trading floor behind me. Equities are now 30% of Barclays. And remember, this was the house that fixed income built. And so the diversification we're seeing in the business, the strength we're seeing in our business is something that we're truly happy about. And to your question, we are doing this in a very disciplined way, with disciplined capital, disciplined cost control. And the revenues keep going up, the returns keep going up. And we're doing it on a fixed capital base and really sweating it. And our capital efficiency is much higher than we thought it would have been at this time. So I'm pleased with the numbers all around.
Venkat, you talk about all round. So let's just talk about whether you're happy with the numbers all round. As you say, the reason Barclays stands out in Europe is because it is diversified. It has the equity side of things. Others have got that as well. But it's also got the fixed income side. And you are probably the most diversified bank in Europe because you have those two pillars. Equities are smashing it. Fixed income a little less so. As you say, you're the bank that was built on that side of things. What do you need to do to get fixed income to be performing at the same level as equities?
Yeah. Well, this was a very great quarter for the equity market because there was a lot of volatility. Fixed income has actually done quite well if you look at the absolute numbers. The comparison with last year suffered because we had a really great quarter in the second quarter last year. But I'm very, very happy with the progress in fixed income, particularly in securitized products, which is a business we've built from nowhere to being high-ranking on Wall Street. Our credit businesses are very high-ranking. Our depth with our clients keeps increasing. One of the statistics we said 2.5 years ago was with our top 100 clients, we wanted to be top 5 with 70 of them. We are now at 65 in the middle of this year. So that's great. And the UK businesses are producing over 20% ROTE. The bank itself has produced 16.1% ROTE in the second quarter, and 14.8% for the full year. So we are, reaffirming our guidance very confidently for both this year and for 2028. And as you said, we've upgraded our income.
Venkat, good morning. I want to ask you about AI from a couple of different angles. Firstly, around what it means for the investment banking part of the business and the opportunities that AI creates to do more business. We saw a lot of this on Wall Street, that the AI rollout, the build-out of data centres and all of the other infrastructure created a lot of opportunities within investment banking. Are European banks and is Barclays getting as much access to that theme as you think the US players are?
Yeah. Well, as you say, Anna, there are different parts of AI. There's first how we use it ourselves, and it's an important part of our own investments and our technology investments. Second is what's going on the street. We have clearly been part of the very large debt issuance programs that many of the hyperscalers have done in order to fund their AI build. So we are a part of that because, one of the things we do really well is to help companies finance themselves.
OK, so Europe is playing its role in that rollout. And you mentioned that AI has another dimension, and that's what you do with it yourselves to make your business work better and to get the most out of it. So how do you look at the return on investment in AI, Venkat? How do you measure that, and what is that measurement telling you?
Well, we're early, and it's going to take a long time. What I would say to you is that it's a great tool, and there's a great potential to be unlocked. To unlock the potential, you've got to invest in modernizing your systems, harmonizing your processes, and standardizing the ways in which you do things, which is one of our biggest investments across the bank, and we continue to spend hundreds of millions on it. On top of that, once you layer AI to drive intelligent processes, you will get the best out of it. And so it is a journey that doesn't take place over weeks or months, but over quarters and years. But we're very optimistic about what this can do for us.
Venkat, where's the opportunity for growth now?
Well, we continue to do well in our different markets. Our UK market has been growing quite well. We've been at 5% annualized growth in UK lending. And the UK economy is doing much better than most places in Europe. And so we're capturing market share in the UK, in corporates, in retail banking. Our wealth segment and our prime segment in the UK retail bank is really doing well. We've cut custody fees to zero for our self-directed investment. We've introduced new planning and advice features for wealth management. We see a lot of growth in the UK, and of course our US consumer bank is an entirely digital offering. We've announced a new partnership with Samsung, both for their card and their wallet. We've bought a company called Best Egg, offering direct-to-consumer loans. So there's a lot of opportunity across the franchise, which we are carrying out in a disciplined way, and both building our capabilities and increasing our scale.
Yeah, I see income at the US consumer bank rising 38%. That's a big number. Just out of curiosity, when it comes to the UK, have you met the new Chancellor? Are you going to meet the new Chancellor? When you do meet him, what are you going to say to him?
Well, I had the privilege of meeting him at your offices in London. And look, he's very encouraging for both the industry and the economy. The UK needs more growth and more productivity. And I think the government and both the Chancellor and the Prime Minister recognize that. And they're going to build on the foundations that their own party has created over the last couple of years, deepening the involvement of the leading UK firms and industries in the growth of the country. They say growth in every postcode, and I cannot be more supportive of that. It's the right idea.
It's the right idea. So you like the idea of growth in every postcode. They might be looking for some pretty broad shoulders, though, to lean on in terms of tax revenue. Do you have any thoughts, Venkat, on whether the banking sector can handle being taxed more, whether business can handle being taxed more?
Yeah. Well, look, the banking sector has a very important role to play in the economy. We are indeed broad shoulders, not just in the size of our businesses, but in the capabilities which we offer. The question is, how do you use it the right way? The right way is to use our resources to increase lending into the UK economy. We've spoken about changes that they can do to certain acts to allow greater consumer lending. And I think every pound of capital that they keep in the banking system will be multiplied by 8 or 10 in terms of the lending which we can do. So the right thing to do is to continue to increase the capital in the banking system, not seek to remove it, and then to get us to lend, which is what we want to do anyway.
Venkat, just briefly, is there anything that worries you at the moment? We started this programme talking about a volatile environment around the AI theme. Some people are worried about private credit. What are you worried about at Barclays?
Well, look, I think there's been continued uncertainty in the markets. You spoke about AI. We've seen both a run-up in technology stocks and technology-related stocks, and now some volatility. The crisis in the Middle East continues. The crisis in Russia and Ukraine continue. The UK economy, the US economy have been robust. Employment has been strong. Credit conditions are strong. But they're facing a kind of uncertainty at a global level that's continuing and persistent and not been seen for a while. So I have to worry about that. And we protect ourselves by running good businesses, by being well capitalized.
Okay.
Our CET1 ratio is at 14.3%. So I'm worried, but we try to run a safe bank.
Venkat, thank you very much. Thanks for joining us. Really good to speak to you. The Barclays CEO CS Venkatakrishnan. Coming up on the programme, we'll get back to some of the themes we were just hearing about there. The chip route deepening, sending global stocks lower. Certainly we've seen that through the Asia session. The Kospi considerably weaker. The likes of SK Hynix and Samsung considerably weaker. The Kospi down by 10.7%. We'll dig into what's behind the sell-off, the latest iteration of this chip wreck. We'll get to that shortly. This is Bloomberg.
Tuesday the 28th, good morning. 30 minutes to start of equity trading here in Europe. Europe looks like, to a certain extent, a sea of calm when it comes to what we're seeing globally on the equities front. Nasdaq futures are down circa 1% right now. European futures are barely budging in comparison. Look at that. Euro Stoxx 50 futures down 0.1%. FTSE's flat as a pancake. CAC up a little bit. LVMH to be factored in, caring to come later. All of that is a European story that, as I say, looks quite calm right now relative to the big moves we've seen overnight out of Asia and what we're seeing right now when it comes to Nasdaq futures.
Yeah, that futures picture in Europe, it does stand out for its strength, even though it's flat, doesn't it? And despite the fact that we've had corporate earnings that haven't all looked good, even away from the technology space, from the auto space and health tech. Let's talk about where we are on bond markets then. Quick check on where we're moving here. And perhaps this tells us something important, because yesterday we did see that the markets got a real boost in Europe from, tech concerns aside, a real boost from a weaker oil price. And that does continue to be the case today. We're at 87.32 on Brent, down by 1%. And as a result, we see another day of buying on European bond markets, and those yields just coming down just a touch. But let's return to the concerns around technology, and certainly stocks in Asia are slumping this morning as a global rout in chip makers deepens further. The losses are coming after a Chinese state-backed firm reportedly began producing machines that could rival ASML's dominance in the space. Meanwhile, at Nvidia, more deals and rising leverage are pushing up the cost of insuring the chip giant's debt. Let's bring in Bloomberg senior strategist Neil Campling to talk us through some of these concerns around the tech space. So there's a lot to think about. Chinese competition, what they can do against ASML and the like. But let me start with the concerns around Nvidia, circular financing and all of that kind of activity. Because yesterday we had a story about this involving OpenAI and SoftBank, and then the FT has another story about another data center that they seem to be backstopping this morning. And meanwhile, the Nvidia CDS, the cost of insuring against default at Nvidia, ticks higher. What's it telling you, Neil?
So I think that the big question is what proportion of Nvidia's sales are going to come from an ecosystem that Nvidia's own deals are, to what extent, artificially inflating the demand of the AI chips and an ecosystem. So that's the big question. So the story that came out yesterday regarding Nvidia, the backstopping of the high data center, it wasn't a new story. It was actually out earlier this year, but it was an incremental increase in terms of the backstopping, the funding of the SoftBank deal for the OpenAI. So there's that question around it. So, and actually, Bloomberg on the terminal has got a really good explainer of the whole circular deal stuff. Originally written actually in January of this year, just updated overnight, because there's just more information around this circularity kind of argument. So that's, I think, one of the key things around it. But I would say it all started last week when one of those ultimate cash machines, Google, Alphabet, reported negative free cash flow for the first time ever in a quarter since coming public. I think that was kind of, in a sense, like the lighting of the litmus paper, if you like, the smoking gun that led to, again, the CDS spreads blowing out, the worries over what happens with all of this circularity kind of arguments, and bring some investors who are as old as me, remembering what happened back in 2000 when Lucent had similar kind of risks around the dot-com build-out, etc. And that worries people.
It does, of a certain age, of a certain vintage.
Certain vintage.
Yeah. Are chips still cyclical?
It's different this time, we keep being told. However, as soon as the concern around chips and memory pricing in particular becomes cyclical, then investors will start looking at the chip companies, especially the memory companies, on a price-to-book basis historically, rather than what appears to be a cheap price earnings kind of multiple. Chips have always been cyclical. Memory particularly always been cyclical. Now the memory companies are investing more in chip production.
Yeah, and the Chinese are getting it, and the Chinese are going...
Chinese are going in. The Chinese, we had the big IPO yesterday, which increases their balance sheet to allow them to invest. There is only so much capacity in terms of demand to meet certain capacity. There's more capacity coming on down the line. So I suspect it's a question of when they become more cyclical again, as opposed to if.
I wonder how much what we make of Chinese competition in this space, because it's clear that we think about it as one big market. From the ASML movement yesterday, the share price dropped on the back of that talk about what China can do in the ultraviolet lithography space. But at the same time, in some parts of technology, we think of it as two separate ecosystems, don't we? As if Nvidia doesn't count on any sales into China in some of their earnings reports because of the difficulty in doing business I mean, how should we be thinking about the China West technology landscape, do you think, Neil?
There's definitely a battle over frontier AI models and who has the best technology. And clearly, China has been without lots of IP in the core building blocks for a number of years now. And yet they do seem to be coming up to speed very, very quickly. And we heard this from some of the models that were announced last week. So once we get, are they playing fast catch-up? They're no longer years behind, it would appear. The narrative around the ASML machines yesterday, we're talking about less than 5% of ASML sales. It's not necessarily the impact to the revenues longer term, but it's just a change in narrative that is concerning people.
The gap is closing and closing fast. So we now look forward to the hyperscalers. The what is it, 4 of 7 we get this week? What's the smart move here? For what they have to, if they come out and give big numbers, we're going to spend billions of billions more. How's the market going to react, given the setup that we have right now, Monday, Tuesday? Going into Wednesday, Thursday, the setup feels quite negative. The market is nervous about companies that are spending money. They're nervous about when the money comes back, when cash flow goes. All of these questions are on the table going into the numbers. Is the bar, where is the bar?
Well, I mean, the bar is set, I think, in the run-up to this in terms of will one of them break ranks and actually potentially slow spending? That's the kind of question I wonder whether someone like Microsoft will step back with their first fiscal year guidance, forward guidance this week. Will one of them break ranks? Meanwhile, there is a little tech company that isn't committing hundreds of billions of dollars to AI capex.
Yeah, you might have heard of it.
You might have heard of it, called Apple. Are they sitting there to wait to see who pans out to be the winner in this space and then just rents the capacity off them without committing those hundreds of billions of dollars? So it feels like somebody has to blink first, don't know who that's going to be. Meanwhile, Apple is sitting there waiting to work out and find out who the winner is.
Or buy some of these companies potentially.
And we get numbers from Apple as well this week, don't we?
We do indeed.
Yeah, as well as the hyperscalers.
Yep. New boss over there, maybe a new strategy. Neil, nice to see you. Thank you very much indeed. Busy week coming up. We're not done just yet. Neil Campling joining us on the tech trade. We'll go from tech to luxury next. The key fashion and leather goods unit at LVMH just about overnight, eking out some sales growth. We're going to dig into the numbers. French luxury front and centre. We get Kering as well a little bit later on. That is all coming up. This is Bloomberg.
Welcome back. This is the opening trade, 7:42 here in Europe. And the European futures picture, well, it's just turned into negative territory, but it's not driven by any of the major markets you see on that board. So FTSE 100, DAX and CAC futures all pointing slightly higher. We've got plenty of earnings stories to talk about this morning. Euro Stoxx 50 futures, though, broadly pretty flat. That's not a bad performance given what we're seeing in Asia, but we'll certainly be recapping on some of the earnings stories that we've had this hour and the hours ahead of this, and overnight, in fact, as we get closer to the European trading day. We'll park that thought for one moment and get back to the oil story in the Middle East. Oil is extending declines after President Trump says the US and Iran are engaged in diplomatic talks to end the Middle East conflict, even as Tehran says no formal negotiations are taking place. But Trump also warned the two sides would return to fighting if negotiations didn't result in a deal.
They want to meet, and we're meeting. We'll see what happens. There's a chance we can make a deal. Without what we did, they wouldn't even be talking to us. They requested a meeting through their surrogates and directly. And we're meeting, and, good things can happen, I guess.
Let's get more details with Bloomberg Horizons Middle East and Africa anchor Abir Abu Omar with us once again. Give us an update then, Abir, on what's been happening overnight. We see the oil price continues to track lower, 86 now the handle on Brent, 86.36, down by more than 2%.
Good morning, Anna. Well, I mean, you alluded to it in your intro. A lot of back and forth between the U.S. and Iran. President Trump, as you have said, and as we've just listened to, said that a breakthrough, yet another one, could be possible, but that if Iran doesn't agree to some of the concessions that the U.S. had laid out multiple times, hitting Iran again could happen. Meanwhile, we don't have a formal response from the Iranian side. Iranian foreign ministry officials have said that they could put through delegates to the United United States. But again, we don't have any substantial negotiations happening between the two sides. Meanwhile, the fighting between the two parties has stopped since late Friday, when after 13 consecutive nights of attacks by the United States, all of a sudden we saw a stopping of hitting the targets in Iran. Iran later on Sunday is saying that it will suspend attacks against shipping in the Strait of Hormuz, but also countries in the region. Those have included Kuwait, Jordan, Bahrain. Meanwhile, Anna, and what's more important here is the Strait of Hormuz. While the fighting has indeed stopped for the time being, the U.S. maintains its naval blockade on Iranian ports. Iran is also threatening ships that don't stick to the routes that it had laid out. And so movement there is pretty much still paralyzed when it comes to ships making their way through. So there is a distinction to be made between the reality of the situation, that is the paralyzed movement, and what oil markets are interpreting. And this is why you're seeing Brent crude now at, as you mentioned, $86, $87 on the barrel. Parallel to all of this, equally important, Anna, is the fighting that is happening between Saudi Arabia and the Houthis in Yemen. That is also affecting the movement in the Red Sea, Bab el-Mandab, another strait, which Saudi Arabia had resorted to throughout the course of this war. So we're watching parallel movements, or a lack of movements in those waterways. And that is something we're going to keep an eye on, as well as a return to those negotiations between the United States and Iran, if it is going to happen over the course of the week.
Kabir, thank you for the updates. A bit Abu Omar, Bloomberg, Horizons Middle East and Africa anchor, joining us out of Dubai with an update on what's happening there. Let's come back to the stock story. Around 15 minutes ago, the Cosby closed down 11%. 11%. That is an epic intraday move for an index. Let's go to Anthony Stevens in Hong Kong to get an update on what we've seen overnight out of Asia. Anthony, that's a big move in anybody's book. Yes, this is a market that has been pushed up very strongly. Yes, there's a lot of leverage here, but an 11% move to the downside. Is there any sign of a bounce?
Well, it's an interesting index, right? It's a two-stock index, and that speaks to why volatility is so high. It's actually single-stock volatility. And these two single stocks are in the memory space, Samsung and Hynix, and they have been materially disrupted by these headlines around the DUV space. The DUV space basically allows China to mass-produce cheaper memory to kind of fill in the gaps that the HBM kind of curbs have put on China. Now, this is the speculation that the market is running with. We don't have a lot of information on exactly what the technical specifications of the machines that are supposedly being produced in Shanghai, and the number being produced is around 20 into 2027. So this is not a very high number of machines, but the capability of China to ramp up production is really well known, and across Asia, not just in Korea, anything that can be made with DUV machines has gotten hammered today. We are talking about NAND in Japan, which is down, Carrick share is down 18-19%. We are talking about substrates in Taiwan, which is all pegged down, limit down. Even China itself, China has disrupted itself with the Chinese Chinext index down 7%. So a lot of the simpler chips made in China are now trading limit down as well. So this is an ongoing theme. What can these chips be made to make, and how many of them are out there, and how much it will increase the Chinese production capacity is up for debate. But this comes at an extremely fragile time in AI sentiment, as worries around the circular trade meet worries around Chinese LLMs and their efficiency in using these resources in the first place. So a lot of headwinds on the AI hardware trade, but you are seeing some signs of life in the AI software trade, which is what kept the S&P flat and what is helping Europe today as well.
Yes, and it helped Europe yesterday. We saw, ASML was weaker, but SAP continued to impress, as Guy was pointing out earlier. So we're concerned about Chinese competition then. That seems to be one of the threads, and that, to some degree, was a story in Europe yesterday. What concerns you about the CDS story over at Nvidia and over at SoftBank, Anthony? Is this something that we should really be watching as we continue to document cases of what are called, the circular financing concerns?
Yeah, yesterday's CDS move in Nvidia marks a kind of change in sentiment around these circular financing deals. Nvidia is an absolute cash machine, so it's been very kind of resistant to any kind of credit worries. But yesterday you saw a small blip up in the CDS, which kind of freaked people out. And that's because it has a knock-on impact to other AI fundraising, not necessarily Nvidia's balance sheet, but other people who are coming to the DCM market. The DCM market is massively full of AI deals to the back end of the year, and any movement in kind of a bellwether CDS, joining the likes of Oracle, SoftBank, Amazon, Meta, that have materially weakened already, puts pressure on this fundraising and the prices at which this debt can be raised. Now, debt financing has become very important as equities have started to come off a little bit for hyperscalers. So people are more likely to go to the debt market given how tight spreads are versus history anyway. So spreads are very tight, but let's look at the pricing people managed to get in the deals in the back half of the year. And based on that pricing, they get to determine how many of these chips and data centers they can build. So the two trades are tied together at the hip. We need to watch the CDS, and we need to watch what kind of hardware people end up buying in the end.
Anthony, great stuff. Thank you very much indeed. Anthony Stevens joining us with the latest around the tech story. The numbers are dramatic this morning. Makes luxury feel relatively safe. LVMH, key fashion leather goods unit, home to Louis Vuitton, of course, Dior, barely eking out sales growth last quarter. The conflict in the Middle East certainly deterring wealthy shoppers. Organic sales at the division, the group's most profitable unit, rose 1%. The estimate was 1.52. That was certainly coming out of the analysts that we'd surveyed here at Bloomberg. Angelina Rasque joins us now. She covers luxury out of Paris. Angelina, what stands out here? The stock looks like it's called a little bit softer. Why is that? The numbers are okay. They're not great, but they're okay. So what is the kind of the takeaway from these figures?
Hi there, Guy. Indeed, I mean, the positive was that the key fashion and leather goods unit returned to growth in the second quarter. That was for the first time in 2 years. So that's obviously the unit that includes brands like Louis Vuitton and Christian Dior Couture. However, the growth rate was slightly disappointing, so I think investors were expecting a little bit more. The positive is that Dior in the second quarter grew slightly more than the unit average, and it was led by growth in the US, especially double-digit growth rates. However, we're not seeing really strong recovery signs in China, which is a crucial market for luxury goods. So that's perhaps what was missing. On the positive side was a watches and jewelry unit, and really it was jewelry because watches were negative, but jewelry, it was led by Tiffany and Bulgari, and that's similar to what we saw. I mean, it grew 11% in the second quarter, and that's similar to what we saw with Richemont, the owner of Cartier and Van Cleef. I think in these times of uncertainty, the aspirational consumer especially, they are quite keen to see, they probably see more value in jewelry, a gold bracelet, gold jewelry, because that will probably keep the value in the long term.
Angelina, thanks for the update. Bloomberg's Angelina Rasque will certainly keep an eye on what's happening with that stock at the open. There are other stocks that we need to focus on. Plenty of earnings out this morning. Bloomberg's Alex Morgan has a rundown of the other stocks to watch. Alex, good morning.
Morning, Anna. Well, good luck to all of us. We've had our coffee this morning. It is a busy one. Let's kick off with Barclays. It's equities here, really driving things. Traders there having their best second quarter in 4 years in terms of the haul. Let's put that in context with Wall Street peers, where, again, we've seen stock trading really reaching all-time highs and surpassing the records. You can see Barclays here around 45% increase, but have a look at some of these other Wall Street names. JP Morgan around 86%. You can see their equities really driving things there, particularly for Barclays as well. Let's turn it over to car makers, though. We know that German car makers, European car makers, are experiencing pressure on a number of fronts. We've got Mercedes, they're experiencing a bit of a drag in China. Those details out this morning. Keep an eye on them. They're not alone, though, of course. Other European names, including BMW and Porsche, we'll see this week, struggling. When it comes to Mercedes, though, you've also got competition on the home turf from Chinese rivals as well. And then kicking over to Unilever. Well, here, we might have had a bit of a World Cup deodorant boost. That was a thing analysts were looking for. Overall, they've had a bit of an interesting year. You can see year-to-date down around about 5%. However, they've beaten estimates in these sales, particularly due to soap and deodorant in the emerging markets. We could have done with some of that over here, watching the World Cup in England, but that's another story. Back to you guys.
That's the weirdest thing I've heard all day, Alex. Thank you very much, Bloomberg's Alex Morgan. World Cup deodorant
I actually wrote
boost.
that down.
Yes.
World Cup deodorant boost.
It's worth writing down. Sometimes the strangest things are.
Okay.
But we need to focus on Philips as well. Healthcare supplier. A beat and raise, but mostly driven by tariff refunds is the conclusion from some of the analysts. And so maybe that limits the impact.
Yes, it looks like it's going to be a negative open for Philips. And I think the reason for that, judging by the commentary that I'm reading this morning, seems to suggest that that's the China weakness story being factored in to what they are saying. So, yes, they've had some benefits on the tariff front, but it's not... I guess that's seen as a one-off and not something that's going to be sustainable. Anyway, Roy Jakobs is going to be joining us very shortly. We will find out exactly what he has to say. I think he's going to be joining us in the back half of the next hour. It's a really interesting market this morning. So what do? Do you continue with the trade of buying SAP? Is that the antidote to the chip weakness we see in ASML? Europe looks fairly flat, but there's a whole load of other stocks that are going to get priced in this morning. LVMH, Barclays, lots of really good names out there.
Lots of earnings stories. And then we had the Asia chip sell-off. We've got the Nasdaq futures picture looking weaker, down by another %, as if there's sort of a continuous thought there. But Europe provides something of a speed bump in the way, a positive one perhaps, or maybe just a flat one. We will come back with the opening trade. This is Bloomberg.
Morning, how you doing? A couple of minutes to go until we start trading here in Europe. Just looked at European futures. You'd think, you know what, there's nothing going on in the world right now. Nothing to see here. Move along. It's really boring out there. Of course it isn't. Look at the Asian session. Look at what has happened with the Kospi overnight. The Japanese market, the chip stocks, all under pressure. Look at what happened yesterday in the United States. To a certain extent, there has been some of the action below the surface here in Europe. Look at what happened with the ASML yesterday, SAP. This is the chart yesterday. This is the one you got to price in first thing this morning. That's where we went out in Europe. We were a little bit higher into the close yesterday into the United States, but US futures are, particularly on the Nasdaq side of things, very negative this morning. We're down by circa 1%. So this is the picture we have in Europe. This is where it leads us. The Euro Stock 50 futures that is doing nothing. And FTSE futures that are up by 0.1%. DAX futures that are up by 0.2%. CAC futures aren't really doing very much either. If you're looking for a place to kind of relax and take a deep breath, Europe feels like that is the place to do it this morning. At an index level. Below the surface, there's some action, Anna.
Absolutely. That is the role of Europe today, to allow you to take a deep breath. But let's look at some of the individual names where we might get some more volatility. Philips is in focus, the medical equipment maker. We'll be speaking to the CEO later. They've been flagging rising cost pressures. Maybe that's going to be something that sticks to them this morning. Could this stock move lower, despite the fact that they beat and raised, but some of that was at least to do with tariff refunds. Barclays certainly in focus as well. We spoke earlier on to the CEO. Equities traders certainly delivering for that particular business. We'll watch that stock at the open. And Mercedes has cut its revenue outlook on Chinese luxury. The Chinese luxury dynamics attached to the property weakness in China. We're seeing Guy.
OK, how do we factor that all into our thinking this morning? Let's find out. Let's show you some numbers, give you an idea of what is going on. I'm not sure over the next minute's going to deliver that much excitement, because Europe at an index level, as we've already articulated, is not doing very much. The FTSE is up by a staggering 0.1%. The Kospi closed down today by 11%. So the FTSE 100 flat, doing nothing. And there's been plenty of guests on the show talking about the idea that if you want to hide out, the FTSE could be the place to do it. Stock 600 is up by 0.1%. We'll wait for the CAC to arrive. It's got to factor in LVMH this morning, plus also looking forward to what is happening with Kering. DAX is going to be interesting, what happens with Mercedes. The IBEX is up by 0.7%. I'm going to look into why that is this morning. The AEX, let's see what the ASML story is this morning after the big rout that we saw yesterday coming through for that individual stock. So there's some really interesting single stock stories which are clearly moving things around. The CAC is going to be interesting as well to delve into the details there. But at a headline level, Stock 600 is up by 0.1%, Anna?
Well, if you want to know where to hide out, the answer seems to be you hide out in in some of the consumer-facing stocks, because that's where we're seeing the strength coming through. So personal care is the place to hold out. That is the best performing sector. And within that, we see Unilever up by 5.4%. It's not only Unilever. Reckitt Benckiser is higher on the back of Unilever. We had Alex Morgan telling us about the numbers out of Unilever earlier on, but sales jumping on demand for Dove soap in India, in the United States. So that's clearly doing well for them. And that seems like in the face of all of this tech volatility through the Asia session and still ahead of us into the US session, maybe that is the calming thought that Europe can provide this morning. So that's the best performing sector, is personal care. To the upside, we do have actually most sectors in positive territory. We've got consumer products also on the rise. There are only 5 sectors in negative territory. Technology is one of them, and we're down by 0.8%. The likes of Soitec down by 3.4%, ASM International down 3.3%. So a continuation of yesterday's dynamic, it would seem there. I see SAP is up by 1.1%. So it's a sort of dialed back version of yesterday when it comes to the tech narrative then, Guy.
Barclays is down really hard. It dropped initially out of the gate really strongly. It's still down by 5%. Let's call it circa 5%. Is that credit exposure? Is that the FIC underperformance that we've seen coming through this morning? Is that what is ultimately driving that?
It's being read across into other UK banks, which is interesting. Not to the same degree, obviously, but NatWest is down by 2%. Lloyds Banking Group down by 1.9%. So is it something that's been said on the UK? We'll delve further into the details there and see if we can unearth something. But yeah, at first look, the numbers didn't look bad. And certainly when we heard from CS Venkatakrishnan earlier on, he was pretty confident about certainly the performance that the equity traders had delivered and the rest of the business. Let's widen the conversation. Talk to Paul Markham, Investment Director and Head of Global Equities over at GAM Investments, with us on set this morning. Paul, very nice to have you with us. Thank you. It was a really interesting day in markets. As we've been saying, Europe sort of stands out as an area of calm. Set aside the banking results for just a moment. An area of overall calm for these markets. The Stock 600 up by 0.2%. Yesterday we saw weakness in tech, of course. And through the Asia session, we see real weakness in tech. But is that what you're looking to Europe to provide? Some sort of diversification, personal care seems like the place this morning. But is that the story for Europe right now?
Yes, I think it is, Anna, and good morning. Thanks for having me. I think that the sector mix in Europe is really quite advantageous in this kind of market environment. It is quite heavy in some of those areas which may do better in this kind of more defensive market. It also benefits from more of that kind of value rotation that we may see as a result of some of the dislocation around tech. So I think from that perspective, you should probably expect to see Europe be a relatively good performer. That doesn't necessarily mean that it will make a whole lot of progress on an absolute basis.
Yes, and I have to ask you about the tech, the chip wreck that we're seeing through the Asia session, ongoing selling of all of these chip stocks back to levels that we haven't seen since April, which doesn't sound like very long ago, but we've been on a big old journey higher on some of those names since then. So how does that set us up for the earnings story around tech that we're going to get into this week with numbers from some really big hyperscalers and other big tech names? How are you thinking about the tech narrative as we head into those corporate earnings?
I think there are two aspects to it. One is the basic long-term fundamental story, which I think remains largely intact. The recent news that we had from Moonshot and Kimi, clearly the frontier is now has less of an advantage over some of these other secondary kind of models that we're seeing in AI, and that is a concern. However, I think that what we're seeing on the other side is very significant adoption of AI at a faster clip than we had been imagining. On the other side of that, this kind of position-led rotation was always going to happen at some stage, and it was always a question of what set it off. If you recall, last January we had something similar with DeepSeek, and we're having a similar thing again, and it's always likely again to happen in the summer months when volatility is higher because volumes are lower. So I think my view on that would be to stay in touch with the tech names, stay involved with them, but maybe at lower weightings and wait for the opportunity to add back to those positions as we go through to the rest of the year. And very quickly on earnings, it's damned if you do, damned if you don't. So I think this quarter...
On the CapEx side,
yes,
certainly.
exactly. So that kind of is being taken badly. And even the CapEx beneficiaries, some of the semi-cap equipment manufacturers, for example, are starting to underperform as well. So you can't really find a place to hide within that hardware space.
So this is a buy the dip opportunity.
Not just yet.
No, sure, not just yet, but it is.
But
That's what's
absolutely. I mean, if you think, for example, a stock like Hynix, and there's been a lot of excitement around the fact that, you know, it's on very low multiples. You usually sell Hynix on low multiples. You don't buy it on high multiples. But what you should expect is a higher multiple to sell on on the basis that margins and pricing are increasing very significantly. So the fundamentals there are very, very strong. I just think that there are so many people on the same side of the boat that there is always going to be a situation where there is over-ownership of some of it.
So this isn't the end of the story?
I don't think so. I do think there will be a hiatus and a pause until maybe a bit later.
We go higher from here? Not from here, but we will go higher.
We will eventually go higher. This is not a definitive end, Guy, no.
Right, OK.
So, as you said, still intact, that underlying argument around AI and what it delivers, or the underlying argument around stocks. Can I ask you about the turbulence that we're seeing sort of under the hood on the S&P? Because I was drawn to this slightly complicated line, but I'll give it to you anyway, Paul, and see what you make of it. During 2026, up to this point, we've seen 8 occasions where the weekly gap between the best and the worst performing groups on the S&P has been a double-digit percentage growth. So there's just a lot of disparity within the S&P. And one of our colleagues has written a story about this and has looked back at the other times where we've had that occur, and it was 2000, 2001, 2009. So you can see where this question's going. I mean, are you concerned about the disparity that we're seeing between these different groups and what that tells us?
Yeah, I mean, I think, to start with the positive side, I think as long as we don't start to see the whole market drag down, because we have this skew towards tech, we have high ownership of ETFs and indexed products, which can lead to sort of stop-loss style behaviour, and then you start seeing a ratcheting down, it becomes a trend, and it becomes a rout. I think as long as we don't get into that, then we're OK. And clearly, some of the rotation, you have these incredible stats where, the top 10 stocks in the S&P are worth more than the other 490 and all these kind of things. So I think that all of that, we're not yet into that territory. Clearly, if investors want something less volatile and they want to hide out somewhere, they're going to have to accept much lower or higher valuations on a peg basis, so lower growth style stocks. But as long as investors are staying involved, I think that's very healthy for the market. It's a broadening out, and I wouldn't be too concerned about that.
OK, so that broadening out is a good thing. How does it stand up to the chance that we get Fed rate hikes? And how are you thinking about the Fed? Because we're now at a 40% chance. Some people thinking we could get a hike this week then. That's what that 40% tells you. Some people think, 4 in 10 people perhaps, are thinking that we get a hike this week. How nervous are you going into a Fed meeting where we have that kind of number?
It's a bit of a knife edge, isn't it, actually? Because, the employment numbers have actually been fairly healthy. But, there are some concerns that inflation is starting to get a bit sticky. And there is evidence, that the Fed is now much less clearly dot plot led than it was. You hear comments made about, for example, the UK economy, where inflation has been very hard to drive out of the system, and I think the Fed is aware of that. So I think that there is a chance that rates go up, and it could lead to a bit of a further bout of volatility in markets. That may well become an opportunity for a broader set of assets, but not necessarily just solely in tech.
Does fixed income provide the diversification? How do I diversify my portfolio? If I want to de-risk at the moment, if I'm worried about this volatility continuing, what do I do?
I think, to be honest, Guy, if you think there is still this risk of there being a Fed hike, clearly, fixed income is going to be a tricky place to be depending on where you are. It may be a little bit more or less volatile to be in kind of high free cash flow stocks, ones which potentially have high dividend yields. They could be a good place to be. The S&P, of course, isn't a fertile place for that. Europe is a good place for that. The UK in particular is a good place for that. So dividend yield could be a factor here, actually, in this kind of situation.
And all of this is going to outperform cash, is it?
They could potentially on a total return basis, but it may well be that if rates being now closer to 5 than they are to 4, that cash for a short period of time could well be a place to be if you have that flexibility, particularly as an individual investor.
Paul, what are you thinking about the drop in oil prices that we've seen this week? None of us can, has a crystal ball as to what happens in the Strait of Hormuz and the Red Sea. But what assumptions do you have to make about the oil price and the extent to which this still drives market thinking and the extent to which we can put it on the sidelines?
The really big moves like we've had in the last few sessions where they've been nearly double-digit here and there in either direction are still a concern. I think lower, 1 to 3% moves in the price just have caused fatigue in the market, and I think reacting to it does create a kind of whipsawing effect that, as a portfolio manager, is not really what you want to get sucked into. So, from my perspective, I've tried to sort of ignore those moves unless they become either something which is more of a trend or if they're very, very sharp and very, very significant.
What's the big opportunity you're looking at in Europe, Paul, right now? I'm looking at this Unilever share price move up by 6%, most in 2 years, sales beating expectations. I mean, maybe not that particular company, but are you thinking about things that are resilient to all the volatility?
It's a really key question, Anna, because I know for my time in markets, there's always been a very clearly defined set, until recently, a fairly clearly defined set of defensives. And those consumer staple style stocks, HPC style stocks, really used to fit into that category. The problem we've seen over the last few years on a fundamental basis for those kind of businesses is that branded goods in that space aren't as worthy of a premium as they used to be. Own brand at supermarkets has become a big trend. Input costs have become an issue. Emerging market growth has fallen away. So if you think about the sort of Latin America-driven growth story that people like Colgate and Unilever had in the 1990s and 2000s, that's gone away. So it's actually been quite hard to buy those names with the confidence you used to. It does seem like with this set of results, hopefully there's some kind of stabilisation coming around for Unilever. I think also the valuations reflect the fact that they don't have that cast iron sort of mid-single digit high cash generative earnings that they used to have. So I think that could certainly be an interesting area.
Costs are a big factor for those kinds of companies as well. Paul, great to see you. Thank you very much indeed for dropping by to see us. Paul Markham, Investment Director and Head of Global Equities, joining us from GAM Investments. Let's take a quick look at the Core 6, figure out what is happening here, and get an understanding of kind of how the market sees the world this morning. Nestle on the right-hand side of the screen, talking about that theme. Reflecting that theme that we've just been discussing. But ASML is down again this morning. Schneider is flat, which I think is interesting. LVMH, though, is up 1.1% this morning. So there's a lot going on in this market. Let's try and dig into some of the details a little bit further. Unilever is maybe a good place to start. So let's point Alex in that direction.
Morning, Guy. Yes, well, we saw the red head there. Unilever was up 6.5% just a few moments ago. That's the most in 2 years. And, of course, that's coming off those beats in the earnings. And also, it's worth noting that there is, well, there you go, as you can see, ticking up in the green as we're speaking, there is this overall transformation plan that the company is undergoing. And it seems that investors are liking that as well. It's the move away from the foods brands. Of course, we've seen the completion of the spin-off of the ice cream brand and the focus more on these products like beauty and well-being. Let's turn to banks, though. And after talking up the results, the sales from the equities traders at Barclays, you can see sharply down in the red this morning. And that potentially is because there were some misses on the fixed income trading. But also, when we looked earlier at the cross picture, looking across the pond and seeing how well stocks traders have done on the other side of the Atlantic, maybe people were expecting even more over here. Let's turn to Man Group, the investment firm. They also had some earnings out this morning, doing well. You can see up around 8% this morning, also on the move out of the gate. And then you have Orange. Now, just yesterday, they had a statement out, of course, the primarily French telco, about a new project into data centres. Well, also, they're up in the green this morning, advancing around 4% this morning. So a bit of a mixed picture there, but the real leader of the pack is Unilever, and that's coming off the back of those beats, guys.
Alex, thanks very much. Alex Morgan with some of the stocks that are in focus this morning and on the move this morning. We will continue the conversation around Barclays shortly. Shares dropping despite beating estimates. A host of reasons out there. Is it the costs? Is it what they've said about the UK part of the business? Is it the investment banking part of the business? And seeing all of these being cited by various analysts this morning. We'll get to that conversation next. This is Bloomberg.
I'm absolutely pleased with the set of numbers we've published today. You know, our top line income of £8.1 billion is up over £1 billion on the same number last year. Profits of £3.3 billion are up 30% over the previous year. And the investment bank, as you say, has done extremely well, including my colleagues on the equity trading floor behind me. Equities are now 30% of Barclays. And remember, this was the house that fixed income built. And so the diversification we're seeing in the business, the strength we're seeing in our business is something that we're truly happy about.
The CEO of Barclays speaking to us earlier, And the stock is under a little bit of pressure this morning, and we've been citing a number of reasons for that, and different views coming from different analysts. We're down by just shy of 5%. Let's get the thoughts of Bloomberg's Charlie Wells, who's been combing through the details of what all the analysts are saying this morning. And we heard, good morning to you, Charlie, we heard CS Venkatakrishnan there saying that this was the house that fixed income built, and maybe there's room for a little bit of disappointment there. I'm not sure if we're just splitting hairs, but at the moment, something's pushing the share price down.
Before market open, it was looking like this was going to be in the green. Now we're in the red. I think there's a lot of questions here. And it was really hard to find a red flag, at least in the numbers that we saw, right? We saw beats across the board. We saw beats on equities. Equities has been the theme of this earnings season in banks so far. We saw, softness in FIC. That could be, as you mentioned, some of this. We saw, loan loss provisions. I think this was something that I was going to come on and say we should maybe check out loan loss provisions. Those were better than expected. So I think this could be a case of high expectations, right? The comparables are tough. The comparables are tough to the United States. We saw, Goldman Sachs reach, I believe, its highest level in the market ever on the back of these stellar earnings. Yeah. Stellar earnings from JP Morgan. I think this red is a mystery.
Can you compare? Every time we compare Barclays with Wall Street,
right?
Is that a fair comparison? Wall Street now has easier regulations. It has. It's freer capital. It's got better access to capital. You can fund these divisions more. Is it? Yeah. Is it a fair comparison? It just feels like Barclays is a little throttled in terms of what it can do, and I can understand why. It wants to build a diversified business. Yeah. It wants to have all of these various engines firing, and it wants to be capital light in some respects. But can we compare it with Wall Street? Therefore, are those expectations the right ones?
I think your intuition there is right. I think like apples to apples is better than, American apples to... Are there British oranges? I don't know about that.
The apples.
Yes, exactly. But no, I think you're right. And I think looking at some of the European lenders that we're likely to see report this week, I think that's smarter. That's where we get more of this nuance, as you say. And I think, in that interview, which I think anyone watching now should go and rewatch, because it was really good, you asked, your first question out the gate to Venkatakrishnan was, is equities throttled here, right? They did make that pivot in 2024. They are trying to get growth out of that trading, out of that markets division, but they have imposed some self-imposed capital limits there. And so is this a missed opportunity? Is this an opportunity cost? And I think across the continent, we're going to get some really interesting takes here, right? Because 2019, Deutsche Bank, they pivot out of equities. We see a lot of different kind of, strategic moves. And so I think when you look, Europe to Europe, when you look cross-channel instead of cross-Atlantic, you get more of those strategic choice questions. I think those are a lot more interesting.
And we made the point earlier on, Charlie, that this was weighing on some of the other banks in the UK. So it's sticking even closer to the British apples, that we are seeing some weakness coming through in others. And is that because the market is saying, look, there's some specifics about the UK business that are making them nervous? And I'm pulling out this line from Citi this morning. Our concern is that the mix is likely to disappoint, with the three UK businesses showing a combined minus 2% profit before tax miss on a slightly weaker NII. And so if you're looking for something that is UK specific, and then there's the context of a new government, I'm not sure that's relevant today, but that is the wider context from the UK business.
And I think for a lot of investors, I think that's the kind of question about Barclays, right? You've got the markets business, the trading business, so important to their global ambitions, but then basically you've got this sort of domestic lender. And, that's a little bit different of a kind of put together than a lot of the other banks that you see, even in Europe. I think something that was interesting that did stand out to me was that growth in the United States, right? And we know that a lot of banks, we know Santander, for instance, is trying to grow in the U.S. So I think you see potential weakness in the UK, potential growth in the U.S. I think, again, that's a kind of interesting shift that we should be watching.
I give you the Blenheim orange, which is actually an apple here in the UK.
Is this the answer to the question? Is there a British apple?
Well, there are loads of British apples. Maybe not on the British orange, but I found the Blenheim orange. Anyway, Charlie, very nice indeed.
I would eat it.
Yeah, that sounds very tasty to me. Very healthy as well. OK, let's talk about what else is healthy this morning, and that is the Mercedes share price. Up very nicely. This on the back of what is being described here as robust profits and cost cuts. China, though, is a factor in your thinking when it comes to this stock. China and luxury cars are certainly a struggle right now. Elizabeth Behrman, Bloomberg EMEA Autos Industry Team Leader, joins us. Why is Mercedes up as strongly as it is? Are these numbers that good?
The market certainly likes it. I think it's a case of better than expected or less bad than feared. If you think historically, a car-making margin of 4% is pretty dire. But on the whole, as we've seen from the German car-making peers of Mercedes, namely VW, and the Audi brand would be the direct competitor, of course, and BMW, they've all been reporting far lower profitability. What this result tells us is that some of the cost-cutting efforts at Mercedes are paying off. They're also launching this really broad product launch, and that's reaping some results as well for them.
It's really interesting, Elizabeth, to see that the market is taking the glass half full view of Mercedes today. And I mean, sometimes you see that when a market thinks the bottom is in and they're ready to believe again in the story and they're looking for the first signs of a turnaround. But this is a sector that is still under so much pressure.
Absolutely, it's still under so much pressure. And Ola Källenius, the CEO, also pointed to more cost-cutting efforts needing to happen, particularly at German sites. We know from VW that in Germany in particular, it's really hard to shave costs significantly because of the labor setups. Like VW, where the situation is even more complex for significant job reductions, Mercedes has a guarantee in place that precludes it from firings of workers for the foreseeable future. And at the same time, in the Chinese market, Mercedes is continuing to struggle. And during the second quarter, we saw how the market slide at Mercedes outpaced the overall market downturn. And that's because of course, of local rivals gaining ground, particularly at the electric vehicle end.
Elizabeth, thanks very much. Thanks for joining us. Bloomberg's Elizabeth Behrman with the latest on Mercedes, and we brace for other earnings from that sector, of course. Let's turn our attention to personal care, and Unilever is in focus, and this was one of the standout performers to the upside that we spotted out of the gates at 8 o'clock this morning. It's paired some of those earlier gains a little bit, but it's still up by 4.6%. And I'll pull out a couple of lines coming through from some of the analysts this morning. Standout is one of the phrases being used by Barclays analysts. Scant picking for the bears is another phrase I see coming through. Very strong volume growth, another phrase coming through. Emerging markets, there was a high expectation they'd do well in EM, but it's beaten those expectations. And so a host of positives around Unilever.
I did not expect a World Cup deodorant boost.
No.
But that's what I think is the hot weather.
Yes.
Maybe probably is a more contributing factor.
Yes.
Maybe the World Cup just.
You wonder what we discussed in the breaks. We were discussing this earlier on. Whether it's the World Cup, whether it's the hot weather. But Philips also in focus this morning.
So it's getting crushed. Stock's down by 9%. Why? We will find out shortly, but we are now trading at 21.39. I'm looking at a one-year chart. We are now at a one-year low on the stock. June, July has actually been okay. It's definitely rolling over now and rolling over pretty hard. Roy Jakobs is the CEO of this business. We're going to talk to him very shortly, 8:45 London time.
We'll be back with more on the markets shortly. This is Bloomberg. Welcome back, everybody. This is the opening trade. 30 minutes into today's session, and Europe delivers you something a little greener than the rest of the world and some earnings stories to digest this morning. So we're up by 0.3% in the overall markets. This really is in contrast to what we've seen through the Asia session. It wasn't just 10% down on the Kospi, it was also considerable weakness in Japan as well. But that's very much the tech theme. Europe played some of that yesterday. We saw ASML very much weaker on the back of concerns around Chinese competition in yesterday's session. But we're stuck here in Europe between that theme in Asia and then into the US, we are looking at Nasdaq futures and E-minis that are still negative. So it's as if the tech theme has further to go. But in the meantime, Europe does what it wants with its earnings stories, and we've had plenty of those. Top level then, Guy, we're making progress across European stocks, up by 0.3%.
It's amazing. It just kind of stands out so obviously as a big difference compared as a differentiator compared with some of the other markets we're watching right now. Let's break it down. Higher 412, lower 177. Let's call that 2-1. Volume's actually fairly decent today, which is interesting as well. Tech got battered yesterday. Deodorant is doing well today. Let's talk about the deodorant trade. Unilever up very nicely on the back of its numbers this morning. The sector's up as well, so it's got a tailwind from that kind of rotation narrative that we're watching. But look at Unilever. It is up by over 5%. Now, LVMH was up. It's now down on the back of the numbers that were delivered last night. Remember, we've got Caring out with numbers a little bit later on as well. Let's call LVMH flat. Man Group, we had the CFO on the show a little bit earlier on. Inflows look strong. The market likes what it hears, and the stock is rising on the back of that, despite actually a fairly decent performance that has been delivered by that stock so far this year. Let's turn the tables and look at the underside of the table and figure out what we're seeing on the downside. Phillips, is this a cost story? Yeah, probably is a cost story. It's not a tariff rebate story because the stock is being marked down really strongly on the back of the numbers. Look, Phillips is down by 9% right now. Barclays is also under significant pressure as well. Why? I don't know. To be honest, I'm really struggling with this one this morning. As somebody pointed out to me a little bit earlier on from Bloomberg Intelligence, maybe it's simply that there's an awful lot of buys on Barclays right now, and maybe some of that is simply being unwound right now. There are other reasons out there. It could be just as simple as that. And ASML, after a big drop yesterday, is down by, let's call it another circa 2% today on the back of this continuing concern around what China is doing in the lithography space, Anna.
Let's get an update then, Guy, on some of the other stories we need to know this morning. Wildfires in France and in Spain that forced the evacuation of more than 300,000 people have stabilised, but officials are warning that another heat wave expected this week will make the fire's evolution unpredictable. The Spanish and French governments are now studying ways to funnel money into the regions that are impacted by these fires. President Donald Trump says the US and Iran are engaged in diplomatic talks to end the Middle East conflict, but warned the two sides would return to fighting if negotiations didn't yield a deal. Trump's remarks came after the US held off attacking Iran for a third straight day, and Iran paused strikes on Gulf countries. Separately, Bloomberg has learned that Oman and Iran are trying to reach an agreement to restart shipping through the Strait of Hormuz. And a sell-off in semiconductor stocks is continuing today as fresh signs of China's progress in the advanced chip making and mounting concerns over the AI spending boom spark another wave of selling across the sector. The Kospian's index plunged in the Asia session, triggering a trading halt, while memory giants Samsung and SK Hynix each slid more than 13%. Guy.
Okay. Let's move on. Let's talk about what we're seeing in terms of the private credit story and what is happening. Holdings in private credit assets continue to rise amongst insurers and pension funds. And it's making people worried. Certainly been causing concern at a bunch of central banks. You take a look at what they're saying. The ECB is one that stands out. The growth in private credit holdings certainly is an interesting story that is quite niche at the moment. Does it become a wider story going forward from here? It certainly prompted one fund manager to launch a new fund to take advantage of any downturn in this market, i.e. the insurer's exposure to private credit. And if the private credit side of things goes bad, what happens with the insurer's share prices is basically the idea here. Let's talk to the founder and CIO of the company behind this, Lee Robinson from Altana Wealth. Good morning.
Good morning.
In 2 seconds, more than 2 seconds, 10 seconds, just explain to me what your concern is.
Well, having been through, the dot-com, been through the great financial crisis, been involved in those trades, involved in the Big Short, when you look at private credit and you look at the sheer amount of money that flowed in a short period of time, and the lack of due diligence was done, it echoes the financial crisis, right? Bad decisions being made. And we saw this earlier this year with First Brands, Tricolor, MFS. We saw that due diligence wasn't being done. And then we start digging deeper and you say, well, who holds these awful positions, right? As you said, pension funds and insurers. And when we were interviewed on Bloomberg, hats off to the journalists Abinar, Liza and Tassos last month, we had a huge number of incoming calls. Huge number of calls from concerned maverick citizens who have done the deep dive to big hedge funds, to other people. And when you look at this, there's so many red flags. So you've got regulatory arbitrage. So clever people are saying, I can get better treatment of my insurance capital if I move to Wyoming or I moved from New York to somewhere else. So you've got regulatory arbitrage. Then you've got ratings arbitrage. You go, well, if I go with this rating agency, I'll get a triple B, but if I go with this one, I'll get a B+, so I'm going to go with this one. And then you find out that the private credit companies are giving the EBITDA estimates and the multiples to the valuation agents for their funds. And then you start looking at all these red flags and you go, hold on, what's going on? And then you look a bit deeper and you go, well, clever people are saying, well, if you put 30% capital as an insurance company against this debt, okay, it's maybe reasonable. But you know what? If we split it up into mezz and senior and equity, you can put 19% of capital against it. And this all rings like subprime mortgages, right? So there's a lot of red flags coming through at this stage. And so just to finish, and then another red flag is, of course, you've got the parent companies pushing all the bad credits into their subsidiaries. So these cross-holdings are happening. Well, you saw with Blue Owl when it had to, had those redemptions earlier this year. So people are very concerned about, shall we say, malpractices.
Okay, so that's the theory. You created a fund to look at this and potentially interest in the fund. How much are you seeing? Are people putting money into it, or is this just kind of theoretical exercise at this point?
Look, we're trying not to be big-headed. We're very good at looking at asymmetric returns. So when we got into Bitcoin in 2014. Why? Because we thought it could go down 50%, but it could go up 10,000%. We got in the dot-coms because of the same thing. We got in the Big Short because we thought we could lose 2 or 3% but make 50. The great thing about this situation at the moment is the spreads are really tight. They're close to their all-time tight. Some of these insurance companies are 80 basis points, 70 basis points. They've been as tight as 60 basis points on the CDS. So if I'm wrong, I'm not paying a lot to get it wrong, and I can put a lot of leverage on that at 60, 70 basis points that I probably wouldn't at 200 basis points. So that's one thing. Volatility, implied vols are not that high. And prices of assets, including AI stocks that are related to a lot of this credit financing, by the way. There's a lot of them. Meta didn't even have a CDS a year ago. Right? It's now, even though it was issuing billions and billions of dollars. Go on now. Yeah, go on now. And you know which way that's going, right? I mean, it's not going to go to zero overnight. So you can play these trades, and then you've had the fraud. You came into January thinking there'd be 3 rate cuts this year. Yeah. So people were buying duration. People want to be in duration. Now you're talking about rate hikes. Yeah. You're seeing a situation where private credit was sucking in money from retail. You now got redemptions. And people are saying, well, the redemptions have peaked. Well, to me, the numbers are higher than quarter one. So how does that work? So you've got tailwinds that have turned into headwinds. You've got tight levels, and you've got malpractices. It sounds like a trade you should be in.
So it's a lot for you to worry about, or a lot of opportunity, perhaps.
A lot of opportunity.
Yeah, to out there, Lee. So in terms of the CDS and the way that you play this, which is in the main, or has been up to this point, a lot to do with the CDS, is this because you think that the concerns around private credit are so great that insurance companies are going to be in trouble? Or is it that you just think the CDS is mispriced and people don't see that actually there's more risk here than is priced into the CDS?
I think it's both, isn't it? I think you can have a perfectly good credit trading at 60, 70 basis points, but people get concerned and it widens out to 200, 300. So it doesn't need
to collapse. It just
and then it comes back again a month later and you take your profits. I think there's that. And then there's also that credit one really is a bad credit and you make a lot of money. But let's say you didn't have it in your portfolio, but guess what? Every risk manager has to cut all their positions. And this is what we saw in the subprime, right? As soon as the triple Bs were going down to zero, everyone had to sell their single As. And it's a risk-off scenario. So we think the big problem here might be that, let's call it insurance company A, I'm not going to name them. They got over 40% in level 3 assets, which means they're almost impossible to sell. Right? So when the regulator wakes up and says you've got to put more capital and you need to sell assets, they're not going to be able to sell the level 3. So they're going to have to sell the level 1s and 2s.
So you sell what you can, not what you wanted to.
So the spreads widen, I think. And so you get this credit spread widening in general across the whole sector as well.
And we have seen some central banks being a bit worried about this.
Not worried enough.
Not worried enough, you think? OK. But in terms of your underlying worry, so you're worrying about private credit and where the risks are there and whether they are mispriced right now. Is that because you think that AI is just going to be so amazing it floors software stocks And is it based on a belief in the power of AI, or do you not need to worry about what AI really is going to do to?
Well, AI is not helping, right? In that it's sucking out a lot of money, right? I mean, you saw SpaceX do $19 billion of debt after their IPO, right? And you've seen Meta do $27 billion. That money's coming from someone else's potential credit, right? So if you're a not such a lovely name in the AI space, you're somewhere down the list and you're trying to raise money in June 2026, and you're not going to be getting any calls from your bankers if they've got to focus on SpaceX. So that money is sucking out, right? And it doesn't help that most of our governments are issuing a lot more debt that's sucking out there. So rates could be going up. Credit spreads are very tight. Who's going to buy this duration? So we think credit spreads widen out. And if they widen out, there's knock-on effects. Yeah. Less money comes into private credit. People start losing money. Pension funds have to sell assets. It becomes a vicious circle.
Outside of credit, we're seeing, though, growing concerns around what is happening with the chip trade, the AI trade more broadly. We're about to see a series of hyperscalers reporting numbers. Some of them are gone, and we saw this with Alphabet going cash flow negative. The game seems to have changed quite significantly. What do you see happening next? Like, how does this trade unfold?
Look, we all love AI. I think everyone loves AI. But one of the things that struck me from the article last month in Bloomberg was the number of incoming calls, which tells me that people, they talk in public how they love AI, and they look like an old fuddy-duddy, doesn't understand it, right? But in the background, they're going, these prices are insane, right? The multiples of sales that are on quantum stocks, that are on chip stocks, that are cyclical. Who's buying these chips in 2032, 2030, when there are established winners? Because not Gemini, OpenAI, Anthropic, Grok, not all of them are going to be winners. And there could be Chinese winners, by the way. It might not be any of them. So if not all of them are winners, then this massive race at the moment to become number one, number two is over. They're not going to spend all that capex and all that money. So the forward earnings of these chip companies, I just not seeing where it is. So I think people are starting to wake up to the fact that these are companies that you're looking at for 20, 30 years of earnings. They're going to have a big order flow in the next 2 or 3. But where's the next 27 years coming from?
Lee, thank you very much. A lot to think about. Thanks for joining us. Lee Robinson, Altana Wealth founder and CIO. Let's move to something different. We just want to keep you updated with some other news flow that's happening around the world, and this comes from Japan. A magnitude 7.1 quake hits Japan's Kumamoto. A tsunami caution has been issued. This is all according to the Japan Meteorological Agency. The maximum shaking intensity was 7 on a scale of 7. So we're keeping this very much in focus and under review.
Coming up, we're going to be talking about Philips. The stock is under significant pressure this morning. The company warning of rising cost pressures. Certainly it's grappling as well with waning profitability at its key diagnostics and treatment division. Input costs into that business, a challenge right now. Roy Jakobs is the CEO. He is next. This is Bloomberg.
Welcome back. This is the opening trade. Now, Philips shares are slumping this morning. The Dutch company is warning of rising cost pressures as it grapples with waning profitability at its key diagnosis and treatment division. Joining us now with some details, Roy Jakobs, the CEO of Philips. Roy, thank you so much for being with us. So the stock is under a bit of pressure today, down by 9%, Roy. And I wonder if we can talk about some of the things that might be driving that. Some of the analysts are saying there might be a difficulty in achieving your margin guidance. How confident are you about the margin guidance that you've given to the markets?
So actually, we are very confident on the full year margin outlook that we have been giving. Actually, we opted for the tariff refund. If you look at the first half, we are up 10 basis points despite increasing inflation and tariffs that we are paying. We have said that in the full year, we are dialing up our mitigation actions. We already had 258 million of productivity savings in the first half, and we are generating more in the second half. And as they phase in, including when our new products, our new innovations at higher margins phase in, that will give us the strength also in the margin for the full year outlook. So we are having a healthy pipeline in terms of what we see coming in orders and sales in the second half. Very strong momentum in the personal health business. And as these cost mitigation actions also come through, we feel really confident that we will achieve the full year margin, as we said in February this year, despite everything that's going on around us. And what we did actually do is increase the absolute amounts of the adjusted EBITDA and also the free cash flow for the tariff refund that we collected by very proactively going out to immediately preserve our rights and already get most of that into the Q2 results.
Okay, so is there any more to come from the tariff refunds, Roy? What's your expectation? What are you factoring in?
So actually the vast majority of what would come, we have actually banked, and we are very happy with that because that's actually cash that we have in. There's only a few millions left, so we more or less concluded the tariff refund process in the US. We now see also new tariffs coming, so that's actually what we have been prepared for. When we made the plan for the year, we assumed that we would have to pay tariffs all year long. Now, the fact that we could have an opportunity to claim back, we fully grasped, and also we kind of achieved the goal of getting that money back. And I believe we are one of the first companies who got it back in the vast majority of the refund.
Roy, good morning. It's Guy. Can I just come back to the margin issue? Diagnostics and treatments. The margin there was circa 25% below where the market was anticipating that it would be. Can you tell me why? What happened there? Can you give me some colour as to what happened with that situation?
Yeah, so if you look to Q2 margin, actually the total margin delivered 12.2, which actually was in line with what we forecasted. We had two businesses, Personal Health and Connected Care, that did substantially better. And then one business, D&T, that actually was lower. Still was in line with our plan, but below expectations for sure. If you look to the reasons for that, that is this increase in inflation, also tariffs that we are paying, as well as China impact that is coming into D&T. We said for the full year, we see D&T margins strengthening, but we need time to actually offset some of this cost pressure. And that's actually coming in the second half of this year. So that's where you see in the D&T segment that some of the cost pressure that currently already kicked in Q2 depressed the margin. There was also one-off effect from last year. We had a service booking into Q2 that made the Q2 2025 margin exceptionally strong in D&T. So we keep the trajectory underlying where we see more contribution coming in at the gross margin level. We also see the cost mitigation. And that's also why we are confident that we can reconfirm the full year guide for the group, but also where we see the strengthening of the D&T margin.
What costs in particular caused that you're going to mitigate against in the second half? What was it that caused the problem there? What's led to that number?
So for the D&T business in particular, two. One is cost and freight. The other is also chip cost. So there is materials cost inflation that we see coming through. There are two drivers. Right. Those are the main drivers, and those we need to mitigate. So we know what it is. We also know how much it is, and we will mitigate in the second half.
Are you confident you've got your arms around that, though? Because both of those two costs are highly volatile right now. Freight costs are all over the place. We're seeing what's happening in the Gulf, the Red Sea. Freight costs, if you look at the numbers, are very volatile. Chip costs. Chip costs have been rising very, very sharply, as you well know. Is that a moving target? Are those costs going to be even harder potentially in the second half?
So we have accounted for a rising inflation, including these and also including prices for those. So that actually is what we are offsetting and what we planned for. We also, if you look to one we guided at the beginning of the year, we also built in a margin, a buffer for unforeseen external developments. And this is exactly what we're looking at. So next to our underlying profile, we also had some room to offset. That's why when we came out with the full year margin, we are very strong in reconfirming that we will be within the range that we initially guided for at the beginning of the year, despite the cost challenges that we see, because we have the offsetting productivity, but also we see the traction of our innovations coming in at the gross margin line.
Can I ask you about the Chinese business then, Roy? And you've already referenced that this was part of the numbers for D&T coming in a little weaker. But we've got some strict domestic product requirements for a number of categories in China. And I wonder how that is weighing on your ability to do business in China.
Yeah, I think the China impact, and that's where we saw some new regulation coming out in Q2, where they have a new centralized procurement policy that they're now expanding across all of China. Now, what we have learned when they came out with centralized procurement earlier, but in certain spots, cities and provinces, is that this actually depresses the market volume in total. So actually what we have seen is the market in total is down. That is because you see prolonged timing to work through these new procurement processes. And that hits us, and we are in D&T disproportionately exposed to China because it's a big part of the revenue. And while we are building up, and we saw really good momentum in that in orders, in PD, double digit outside of China, that takes a bit of time before they come into sales. And that's also what you see coming into the second half. So we're shifting some of the volume of China. We have planned for that to be taken up from a stronger Europe and also a stronger North America. And actually the good news is that North America over 12 months is double digit order intake growth. And Europe in the second quarter was double digit order growth. So we really see underlying also that momentum is coming in.
Yep. Roy, great to catch up. We genuinely always appreciate your time. Thanks for spending some time with us this morning. Roy Jakobs, the Philips CEO. Let's get back to the market. Skylar's here. Europe looks like a sort of place to hide this morning.
Yeah, I mean, it's doing much better than Korea is. I think we need we need to remember that Korea is a very different market now than it was 10 years ago, but certainly than other markets globally. So I wouldn't expect the same kind of spillovers. Yes, particularly in tech markets, I'm more concerned. But, you know, one metric is if you look at ETF leveraged AUM in Korea over total ETF AUM, that's at 6% in Korea. So that's quite a high number. In the rest of the world, it's 1%. So, you know, there's more room for speculation to come down in that it was 4% in 2025 and we had a peak of 8%. So we've only done half of that. But it's just a more volatile market. So, yes, spillovers, but maybe not as concerned from a high level, big downside, especially when there's not a really specific catalyst that you can see being negative for earnings in the U.S.
Right. So, yes, that's an interesting one, isn't it? Because will we get a catalyst this week with all of the earnings reports that we get in the US? Did we see the catalyst last week with the cash flow negative on one of the big tech names? Are we still in search of a catalyst then to really crystallise negative sentiments around how far the tech story has run?
Yeah, I think we are. In terms of, yes, earnings have been stronger than expected, and that hasn't boosted the market. But I think until we see kind of broad-based downside, so not just in those big names that are reporting, but over a longer term and in multiple stocks, not just your tech stocks, you're more worried about global growth, then you can kind of still continue. What worries me is when we get that catalyst. Yes, you know, you don't have leveraged ETFs in the same way in the U.S. market, but you do have general leverage is very high in terms of margin debt in the U.S. in June reached a peak high. It's at levels, if you have a denominator in there in terms of total market cap, that are pretty concerning relative to the dot-com, relative to the 2021 bear market. So if you do get that catalyst, not necessarily we'll get that this earnings season, but when you do get it, I'd worry that there's quite significant downside.
It all gets very complicated, Guy, tracking the twists and turns of the tech story. So in the face of all of that, we have Unilever and Reckitt Benckiser up pretty strongly in this morning's session here in Europe.
Europe's the place to hide. Deodorant's the place to be.
It seems so. This is the theme of the morning. 8:56 here in London. That's it for this programme. We'll be back with The Pulse shortly. Thank you to Skylar. That was the opening trade. This is Bloomberg.